Hey friends, Lucian here with the Bullish Bears team. This video is going to be about symmetrical triangles and how to trade them. They are a neutral pattern, but they can go either way, so they can be bullish or bearish. And typically they go with the trend overall. So you'll see when you're doing symmetrical triangles, you want to connect as many peaks or valleys or angular support and resistance levels as possible until price forms that apex point of the triangle. So typically they're even and it kind of forms and comes to that apex or conversion point. And then again, typically price will go based upon whatever the trend is. So, again, in this example, I'll show you a bullish example in a moment, but this is a bearish example. This right here, you'll see price is kind of in a downtrend overall, and it formed kind of that apex point. And what you'd want to do if kind of in a bearish trend, you would go and take a short as price kind of fails that apex area, and then you'd put your stop kind of above that apex area. So if price kind of goes back up and closes above that apex area, you'd put your stop up there. Obviously you can minimize your risk. This is kind of more of just your typical example, but you can keep your losses smaller if price kind of goes back up into this area if you'd like. Again, that's all up to you, but obviously you want to keep your losses small to help minimize your risk. But you would take a short again as price kind of fails this angular support level with a candlestick close above it as your stop for a bearish, if price is going bearish or failing that symmetrical triangle. Now let's take a look at a bullish example, and I want to show you it's not completely perfect. So many times you'll see, patterns, but they're not completely perfect, and you'll see fake outs as well at times. And I want to show you an example here with AMGN. You'll see price right here kind of coming to that apex point. It broke out, so this is where you would take a long position and you would put a candlestick close below here, or if price kind of comes down below the base of that apex area. So a lot of times price will go and it'll break out and then it'll come back down and retest. So that's why I like to also say, there's ways of you can get in as price breaks out of an area, or you can wait for the retest and hold, right? So you could have waited for it to break out, kind of hold, and got in down over in here. So there's fake outs as well along the way with trading. But again, that's where you keep your stop down over in this level. But again, depends on whether you're trading options or shares or time value, what you have on your contracts, stuff like that. But all things being equal, if you're just trading shares, kind of a candlestick closed down below this area, and then you wouldn't have gotten faked out over in here. So this is kind of an example of a bullish, symmetrical triangle that ends up going bullish compared to one that was going bearish. But again, symmetrical triangles are a neutral position or neutral pattern that can be both bullish or bearish. Again, it can trade sideways, and that's why it can go either way, like with trading sideways and consolidation. But if it's going with a trend up or down, it could be either a bullish or a bearish pattern.